Hi, everyone. Welcome to the ESG Reporting and Governance webinar today provided by RGP. I'm Janis Parthun. Presenting along with me is Rachel Jaris. And in the session today, we'll be highlighting regulatory updates as well as governance and risk management best practices applicable to ESG reporting. And a little bit about myself. I'm a VP within our project consulting services team at RGP. I currently lead thought leadership and service innovation around emerging finance, accounting, and risk issues. I'm also the ESG consulting services leader here as well, responsible for methodology development and training within our project consulting services team. And then previous to that, I was with another accounting firm within the risk consulting practice, helping serve clients in global and regional accounts during that time. And then prior to that, I was with the AICPA, advocating the importance of IT and accounting for the accounting profession at large. And then a little bit about RGP. RGP is a global consulting company that serves over 2,100 clients. And this also includes in terms of the Fortune 100, which includes 87 of the Fortune 100. RGP enables rapid business outcomes by bringing together the right people who together create transformative change. And it's also daring to work differently to deliver the future of work today. Okay.
Thanks, Janis. My name is Rachel Jaris, and I've been with RGP just about a year. Prior to joining RGP, I was in industry for many years. I spent 12 years as an internal audit director at 3 Silicon Valley startup companies, where I created the internal audit function, established the control environment, implemented SOX, and did internal audits and enterprise risk assessments. I'm happy to be here this morning for the ESG webinar.
Great, thank you, Rachel. So what we want to talk about today is really first providing an introduction on ESG, providing reporting standards and also regulatory drivers in the next segment, and then also talking through and diving a little bit deeper on risk management and internal controls, and then wrapping up with a summary at the end. But before we do that, we have our first polling question. So the first polling question is, which organizational function do you currently represent? Finance, internal audit, legal, audit committee, or other? And while we're waiting for the responses, I actually have an interesting information I wanted to share for the finance audience here. There was a research study that was very interesting to me. It's actually the 2023 Global Finance Trends Survey report that actually Protiviti had issued. And what was amazing was that the ESG has elevated to #1 as finance leaders' top priority, while it was listed as #7 last year. So I thought that was actually very interesting. And this survey had covered over 900 finance leaders. Now, let's see the responses. Oh, great. So good timing in terms of sharing that trend, because our largest attendance here is finance, and next after that is internal audit. We do have some other category as well. So with that, so just a quick introduction on ESG, a 3-minute overview here. I'd like to just first provide a quick introduction on ESG, which stands for environmental, social, and governance. Here I have the definitions here, but the topic of ESG is not new, and there are significant funds and investments around this. So if you can see here, over 96% of the S&P 500 already voluntarily publish sustainability reports in some form or fashion. And then over 150 billion net new money was generated in 2022 internationally, focused on sustainable funds. And then you have 370 billion an investment targeting for emissions reduction and promoting green technology with Inflation Reduction Act. So you can see here, there's significant interest in terms of to invest and report. And there are proponents that say companies' ESG efforts may influence how they purchase and invest in that company. And companies want a way to be able to share how they're acting responsibly with their employees, along with their customers, with their suppliers, and the environment. But there are also critics, such as the ESG ratings developed that ranks companies, and it has created frustrations for some companies. But then there's also the other aspect in the question of fund and investment products labeled with ESG. So because of this wave of interest, it really has created just a lot of attention with the regulatory and standard setting bodies around this topic. Now, just to elaborate just a little bit more, a company's overarching ESG program will likely have its top topics determined with goals, which includes metrics and possibly targets for future outlook, set and established. And to be able to reach the goals and the targets, the company may have various initiatives in action in order to support the goals. And here are a few examples highlighted. So you can see here example one, let's say for climate change, you have the priority or material topic, and then you have your goals and targets, which might include reducing your greenhouse gas emissions by 40% by 2040. But how would you be able to get to achieving that is through initiatives such as perhaps converting all your transport fleets to electric vehicles to be able to achieve some of that reduction. And now also note that when discussing ESG at the program or the reporting level, this is applicable across multiple topics. So when having to discuss a specific topic or initiative, such as climate change, this is focused on a related goal and likely function specific. Now that was just a brief high-level introduction. Now what I like to do is really highlight a bit more around the reporting standards and regulatory drivers. And as a company embarks on its ESG reporting journey, you can see two different work streams here pertaining to ESG. On the left side, when companies are having to include ESG information in the financial statements or regulatory filings, these tend to be more regulatory driven. And the major US regulation on the horizon is the climate-related disclosures. So the SEC proposed disclosure requirements specifically on climate risk to require public companies to disclose details when filing. And this includes reporting climate risk management as well as emissions in the annual filings. And the other more recent ones are state bills from California, which I will elaborate a little bit within this segment. But there are also other international regulatory requirements applicable when, depending on where a company operates. And so you can see here the applicable requirements, and these are just a few that I've listed here. So for example, within the MD&A, when you're filing your 10K, there are some initial requirements around human capital, and then of course the climate related disclosure that's proposed. And there are other requirements, as I mentioned earlier. Now, if you see on the right side, as you can see, it's beyond the financials, and this reporting workstream is really more strategic in nature. So when a company is sharing ESG efforts around their ESG or sustainability reporting on their websites, it's really tends to be more strategic in nature. Now, if a company has decided to report and publish on the sustainability efforts, it really is more based on what a company wants to be able to report on and having to consider the elements to consider that's aligned to their business. And you can see here the applicable considerations as well that I've listed. There are sustainability standards and frameworks that are voluntary that companies tend to like to incorporate. You want to consider the industry profile as well as the business model, your targets and goals, and things of that sort. Excuse me. Now, there is increasing influence in terms of having to have regulatory bodies addressing this right side. And there's been a major regulation that's been adopted in the EU, and this is the Corporate Sustainability Reporting Directive. And this is a new rule that's requiring companies to publish detailed information on sustainability matters. And I'll elaborate that a little bit more in this section as well. But you can see here, or as I'm sharing this information, the regulatory requirements are starting to impact the right aspect of the reporting workstream. Okay. And so from a voluntary standards perspective, there are two prominent ones. And so it's GRI and SASB. And the first one I like to mention is the GRI, which is the Global Reporting Initiative. And this provides widely used standards for sustainability reporting. And this is structured by specific topic, along with defined metrics to report on, and the topic-specific standards help guide and recommend companies on the reporting disclosures and metrics to consider. And although the organization has plans to develop more industry-specific guidance, there are only a few available at this time. Excuse me. So, for example, if diversity is important to your organization, then you would refer to topic 405, diversity, and represent diversity in terms of the governance bodies and employees as a percentage by gender, age group, or other indicators, as well as presenting metrics on perhaps the ratio of basic salary and compensation of women to men for each of these employee categories. Although keeping in mind from a GRI perspective, there's still a full structure here that's been illustrated here, having to include your overview in terms of the organization, and then it trickles down into topic specific that organizations would still need to report foundationally and then topic specific. I want to clarify that. Now, in terms of SASB, which is the Sustainability Accounting Standards Board, focuses on guiding the disclosure of financially material sustainability information by companies to their investors. And now it's actually part of the IFRS Foundation and the International Sustainability Standards Board, or ISSB, oversight. And this is structured by industry classification, focused on financially material metrics, and the guidance suggests topics for the industry and describes specific accounting metrics to consider reporting on. And from an industry perspective, SASB provides additional industry categories to consider. So for example, in this illustration here, or at least just in any example, when you're talking about consumer goods, there are actually 4 or 7 additional category variations to consider. And that makes sense because there are a number of variations from, could be from a retail brick and mortar to e-commerce. So there are a number of variations, and SASB takes into consideration of that. Now, I wanted to also just have a quick highlight on greenhouse gas emissions. There's been significant discussions for companies to disclose climate risk and emissions, but of course the SEC proposal and now the California state bills have brought this topic front and center. And I'll share some background when you hear references to Scope 1, Scope 2, and Scope 3 emissions. Now for Scope 1 emissions, these are direct greenhouse gas emissions that occur from sources that are controlled or owned by the organization. And this may be based on, you can see here in terms of the company's facilities or from company vehicles. And for Scope 2 emissions, these are indirect greenhouse gas emissions associated with purchases of electricity, steam, heat, or cooling. And for Scope 3 emissions, These are the results from assets not owned or controlled by the reporting organization. Now, this can also, in terms of really, you can see here upstream and downstream activities, but it really is more focused on the whole entire value chain that impacts the organization. And it tends to be actually the largest contribution of emissions for many organizations. So for climate-specific standards and frameworks, there are three primary ones that I wanted to be able to call out and share with you. One is the Task Force on Climate-Related Financial Disclosures, which develops recommendations on information that companies should disclose to support external stakeholders in assessing the risk related to climate change. There's also the Greenhouse Gas Protocol, which provides the framework to measure and manage emissions for private and public companies in terms of operations and value chains. And there's also the Science-Based Target Initiative, which defines and promotes best practices and emission reduction and net zero targets in line with climate science. And now there are additional organizations I'm not referencing here, and so this is just an initial introduction for background purposes in terms of the three slides that I had just presented. And before I dive into the regulatory drivers, we have our next polling question here. So which regulatory requirements or potential requirements are you aware of? The SEC Climate Disclosure Rule, the California Climate Bills, the Corporate Sustainability Reporting Directive, or the ISSB climate-related disclosures? And actually, you know, this might be a tricky question because I think this is actually could be all of the above, and we don't have that option here in the CPE. So understand you might be a little perplexed in this answering this question. So I would just suggest that which one are you most aware of? Let's just go with that. Okay, so the SEC Climate Disclosure Rule is what you're most aware of. And then the secondary is the CSRD. And then the last two in terms of the California Climate Bills and then the ISSB. All right, great. Well, we have all four we'll be talking about, just at least a highlight. So let me just also check on the time really quick. Okay, great. All right. So as many of you are already aware, in March of last year, the SEC proposed rules to enhance and standardize the climate-related disclosures as the investment community is demanding for more consistent, comparable, and reliable information across companies. And the proposed disclosures, specifically on climate-related risks, will require public companies to disclose details on specific content when submitting the filing in the registration statements or annual reports, depending on the timing. And this includes having to address, from an oversight and governance perspective, material impact to the business and the future outlooks, process to identify, assess, and manage the risk, and greenhouse gas emissions, and with scope 3 if material. Now, that also includes impact of possible climate-related events, and this includes disclosing financial impacts when summed cumulatively greater than 1% of a significant line item within the financials, as well as any details on targets and goals publicly set, and any other information that you might have. Now, for larger organizations or large accelerated filers, an additional requirement is to obtain the reasonable assurance on the Scope 1 and Scope 2 emissions, and the SEC proposal includes a phased approach for implementation. And, you know, and I think based on the polling survey, many of you may already be aware in terms of the largest concern or multiple large large concerns, but one is having to address the limited and reasonable assurance requirements, estimating the financial impacts to possible climate-related events, and reporting on Scope 3. So those are the major concerns, and also had been received within the comment letter feedback when the SEC had in terms of the proposed rule open to comment. Now, this rule was anticipated to finalize in October, or essentially last month, but we have not necessarily seen that finalized at this time. And I am hearing now that this is likely to happen towards the end of the year or possibly out to the first quarter, but it's fairly certain that that's going to happen, but the SEC is just taking time to really analyze and determine what should be final in terms of what goes out. But I do want to also talk about from a timeline perspective, because the SEC proposal for the timeline for the large accelerated filer here, this last suggestion, was around fiscal year 2023 for filing for 2024, and with limited assurance to the next year. But in the proposal, this is under the assumption that the rule is finalized in December of 2022. So if the SEC is, obviously the SEC is likely to adjust and present updated timelines, but if the SEC does decide to finalize this year with the effective date of December 2023, it really just bumps out 1 year. And so if you're a large accelerated filer with a 12/31 year end, and if with the potential having this finalized by the end of the year, you may have potentially have to start beginning with the next fiscal year for 2025 filing. So it really is best to start conducting this and providing some advanced preparations in the process. So I just want to be able to call out from a timeline perspective to be aware of that. Now, the California climate bills. This is also a pretty big bill that's really come into law recently for larger organizations. So recently, California has issued 2 state bills requiring companies to report their carbon emissions related activities ahead of the SEC's anticipated rule. And this is now officially signed into law with Governor Newsom signing into law last month, back in October. And the SB 253 is anticipated to apply to quite a bit of organizations, at least it's been analyzed that it may apply to over 5,000 companies, public or private. So to dive a little bit deeper, I want to just call out some of these points that's been highlighted here in the presentation. So for the SB 253, the Climate Corporate Data Accountability Act, this is applicable to companies with revenues greater than $1 billion that's doing business in California, and it's public or private. And the requirement would be in terms of disclosure for Scope 1 and Scope 2 emissions in 2026, with disclosure of Scope 3 emissions for 2027. And now keeping in mind in terms of for these years, this actually means in terms of your information from 2025 to file in 2026. So you want to keep this in mind as well in terms of the timeline and the years that would be applicable going forward. And with this bill, the framework is tied to the greenhouse gas protocol, as well as having to incorporate assurance in terms of Scope 1 and Scope 2 limited assurance starting 2026 to reasonable assurance in 2030. And then also having to anticipate for Scope 3 limited assurance by 2030. So that is quite a bit of information there. And then for SB 261, which is for greenhouse gases, climate-related financial risk, this is applicable for U.S. companies that do business in California with revenues greater than $500 million, public or private. And the requirement here is to disclose climate-related financial risk in 2026 and afterwards every 2 years, with the framework tied to the TCFD. Now, I do have a couple of nuances I wanted to call out regarding these bills. And so I wanted to also bring out that from a revenue perspective, this is not just revenue earned in California in terms of having to have the applicability. This is more in terms of you're doing business in California, but you are also generating this amount of revenue in total. So just wanted to initially bring that out. And then also just in terms of highlighting some of the variations and differences between this and the SEC proposed rule is that if you think about from a SEC applicability perspective, it's really just publicly traded. It's really around publicly traded companies. So the SEC, in terms of the scope, would have the lower revenue threshold compared to the California Climate Bill, but it is also broader in that this applies to public and private companies. And if you think about this conceptually, these two bills combined together, it is almost like the SEC proposed rule in that there's the having to disclose your climate risk associated with it, and then having to disclose your emissions. And then in terms of what's next, I also want to just highlight a bit in terms of what you would want to anticipate, particularly around the SB 253. So what you want to anticipate, if this may apply to you, is that there's likely going to be a digital reporting platform that's needed to submit the information. The California Air Resources Board, or CARB, will oversee the reporting compliance on the assurance, and will need to be able to roll out some reporting guidelines for implementation. And so you'll likely want to anticipate more information around that in terms of next steps. And then also one thing that's also that may be tricky is in terms of that, we're not tricky, but in terms of not necessarily be fully clear yet, is what constitutes doing business in California. And so likely in terms of part of that implementation, more details will come from that, because there are various elements that can be considered in terms of what's being considered doing business, such as, is it sales tax? Is it payroll tax? Because there are variations from that you can consider. And so if you do not file, the consequences likely will be penalties. So that's something to keep into consideration. And then for SB 261, submissions will be reviewed by an advisory group within the governor's office. And I would say similarly, more details to come, because usually when the bills are written out, it's still at a somewhat high level, and then more details come out from the state in terms of the implementation and the filing guidance. Okay. Now, so shifting over towards compliance that's happening internationally. As we advance further, as internationally is advancing further than the US, so ISSB, the IFRS Foundation, created the International Sustainability Standards Board back in 2021, focused on sustainability-related disclosures to help investors make informed decisions about ESG matters. And there's been significant progress since then. The ISSB issued 2 standard sets in June of this year, and this includes IFRS S1, the general sustainability-related disclosures, setting out overall requirements for an entity to disclose and to communicate to investors about sustainability-related risk and opportunities that they face in the short to the long term. And then IFRS S2, climate-related disclosures, really building out recommendations of the TCFD and having to set specific climate-related disclosures, and that's designed to be in use with IFRS S1. And now, while these standards are officially issued, they're not mandated. accept unless the country or the jurisdiction authority decides that the company should comply. So the ISSB is working with jurisdictions and companies to support the adoption, and I would suggest staying close to updates depending on the location that you're at and the jurisdiction applicable. And as mentioned earlier, there's been a consolidation of voluntary standards and frameworks occurring, with SASB being consolidated under ISSB back in 2022. And now TCFD is going to be rolled under ISSB in 2024. And in the EU, the European Commission has adopted this new rule, Corporate Sustainability Reporting Directive, for companies to be able to publish, in terms of being able to publish detailed information on sustainability matters to increase the company's accountability and prevent divergent sustainability standards, effectively starting fiscal year 2024, which is next year. And the European Financial Reporting Advisory Group, or EFRAG, is responsible for developing the European standards and have developed 12 associated standards in the picture presented here. And since then, the European Commission has officially adopted these set of standards issued in July. And I would just say there are little nuances to consider in terms of applicability. And it's a phased-in approach for companies and require consideration of the entity structure and the origin of the revenue generated. Now, at a high level, I just wanted to share that this will be effective starting 2024 for EU-listed companies previously under the Non-Financial Reporting Directive. And then there's also recent communications from the European Commission that the proposed effective dates for sector-specific and non-EU parent companies to push back 2 years. And so there's a range of where it's applicable, starting with EU-listed companies first, all the way through to non-EU parent companies that may have subsidiaries in the EU. And that timeline has been pushed back to 2 years. And so now it's anticipated to extend out to 2030, which that's what I wanted to indicate with the cross out. So for non-EU parent companies that meet certain criteria, this may still be applicable to your EU-specific subsidiaries prior to that. So just wanted to make sure I provide that clarification. Okay, so I know that was a lot to share. So now we wanted to transition to see in terms of, well, you have all these requirements and regulatory drivers. How do you take risk management, internal controls into consideration? So this is what we're going to dive into next, as Rachel and I will speak a little bit more about this.
Thanks, Janis. Basically, in 2022, Deloitte did a survey of approximately 300 executives from public companies and inquired what their concerns were regarding ESG reporting. And as you can see in the chart on the right-hand side, 35% of executives' number one concern was the data quality. In other words, the completeness and accuracy of the ESG data that was being reported upon. Janis?
Yeah, and what I wanted to also add was that in terms of having to have data quality and having governance place, there was also lessons learned for a retail company last year that I was able to observe or read, that what may happen when your organization might lack program governance and structure to manage the ESG initiatives and the integrity of the data being reported. In this instance, there was an apparel company that ended up being investigated by regulators for misrepresenting their sustainability-related products and ended up having to remove their labels from their products and their websites. It was a major impact for the organization after finding out that in terms of what they were reporting from their public-wise in their products was not reliable. Now, I wanted to
Yeah, that brings us
Now we
to
have
our
our next polling question.
Yes,
Yes.
exactly. We talked a little bit about Deloitte's survey on polling questions. Let's talk about what your concerns are. So what is your top concern around ESG data? Is it A, availability or access? Is it B, aggregation or consolidation? Is it C, review, in other words, documentation and sign off? Or is it D, quality, accuracy, and completeness? We'll just take a minute here to gather those responses. Very interesting indeed. The biggest finding here is that quality and accuracy and completeness is the #1 concern around the team, with 73% of people, followed by availability and access to data. Very good. So that means we're going to talk about how to get accuracy and completeness in the data in the rest of these slides. So this is very pertinent. Thanks for responding to this question.
Great, thank you. Yes, this is great timing and also aligned with the survey results that we had presented earlier. So now just to drill down a little bit further, let's focus on the goal of reducing carbon emissions, just as an example here. And in order to achieve this, you first need to understand your baseline inventory. So do you currently have proper inventory of your emissions data? Or does your entity have multiple subsidiaries? And do you have a subsidiary that might be more behind versus others? So first, having to understand your baseline inventory. But then in order to be able to calculate and track and monitor your progress, it's also likely you may have a system to support you in the process. And this could be perhaps a temporary solution or a solution more integrated into your system. And then from a reporting perspective, we talked about a number of reporting efforts that I had shared earlier, but it could be from a voluntary element perspective, having to report your material topics and associated initiatives, along with the references to the standards and frameworks that's recognizable. It could be more regulatory driven with specific requirements. So for example, SEC proposed rule, or other requirements I had just shared. You'll need to be able to consider from a risk management perspective as well. And you'll want to plan ahead to determine whether you want to pull in information that you may have to pull into your annual reports and disclose, or just know what gaps you have. And then from there, being audit ready. And so being able to be prepared for future audits with policies and procedures and controls in place, and incorporating risk management into the process. So, and actually we have, I'm clicking to the next slide. There were references on limited insurance and reasonable insurance. And so what we wanted to do is at least provide some high level background on the type of assurances when you see the references to that. So as you can see here, the limited insurance is a review engagement that expresses a conclusion whether any material modifications should be made to the subject matter, and it's limited procedures only. And so when I'm referring to limited procedures, it's really having to assess through analytical procedures and inquiries. And then in terms of reasonable assurance is an examination engagement and having to express an opinion about whether the subject matter is free from material misstatements. And the nature, timing, and the extent of the procedures to gather evidence is a little bit more extensive and more detailed. And then you have the test of controls. And so, as I mentioned earlier, it's having to have a little bit more extent in terms of procedures to gather sufficient appropriate evidence. And then part of the reason for this difference is having to have, with more extensive testing, is to be able to provide a higher level of assurance for the auditor to be able to reduce the engagement risk to an acceptable low level, and then so that they can express an opinion. So this is just a little bit of background so you have understanding between limited and reasonable assurance.
Thanks, Janis. There's been guidance and communications from various associations on how companies should be taking into consideration the COSO internal control framework when it comes to sustainability reporting. For example, the Institute of Management Accountants, as well as the Institutes of Internal Auditors, have weighed in on this topic. Now, to gauge what companies are doing in the marketplace, let's go back to that Deloitte survey I mentioned in 2022 of 300 executives from public companies. As you can see in the chart here on this page, 90% of companies are applying the COSO framework to ESG reporting process, planning towards a path of reasonable assurance level. And when you look at the COSO cube and you look at this and you consider it on a deeper level, it really all makes sense. From a control environment perspective, you're going to want to consider organizational governance at the entity level. From a risk assessment perspective, you'll want to consider the risk exposure of the organization reporting and disclosing specific data points publicly or to the board. From a controls activity perspective, you want to have policies and procedures in place, along with controls, to provide a level of assurance that the data is complete and accurate. And then, of course, you want to have information and communication and monitoring activities in place to round things out. So, again, basically, it all makes sense when you look at the COSO cube and taking a deeper dive in, it makes sense. Next slide. Achieving effective internal control over sustainability reporting is a publication of COSO, the Committee of Sponsoring Organizations of the Treadway Commission. The paper updates and expands on a 2017 study that leveraged the COSO Internal Control Integrated Framework application to sustainability reporting. The publication provides a lot of interpretive guidance based on the COSO Internal Control Integrated Framework, and we want to note that there are examples incorporated in the paper that are helpful for you for execution and implementation. The intent of the paper is to advocate for greater integration between sustainability and finance teams, and to provide a path forward for improved internal and external reporting on sustainability. But again, the gist of the paper is basically the application of the COSO principles to sustainability reporting. Next slide.
Great, thank you, Rachel, for sharing that. And so, as we discussed applying COSO's framework to ESG reporting, we also want to first just highlight the applicable elements of internal control over sustainability reporting through principle or point of focus examples. So, for example, in the control environment, let's say the board of director oversight, you can see that for board members charged with oversight responsibilities, the board members should have knowledge and the skill set in order to be effective to be able to have responsibility regarding sustainable business. And then from a structure perspective, at the management level, there should be established committees and working groups to be able to have a more formal management oversight structure with reporting lines and accountability. And from a risk assessment perspective, from a materiality perspective, you would want to be able to consider the setting and the carrying out of the objectives, understanding that there are familiarity with financial materiality, but there's also attribute that's applicable to the organizational impact, and it's been frequently referred to as double materiality. So if you're not aware, but it has been in reference in the CSRD as well in terms of the standards that are related to CSRD. Now, from a risk assessment with risk tolerance perspective, you want to be able to consider the risk associated with reaching organizations' sustainable business objectives. And these objectives may be applicable across the operations, external financial reporting, external non-financial reporting, internal reporting, and compliance. And these areas are also illustrated in the COSO paper as high-level examples for a number of companies as well.
Okay.
Rachel, would you like to cover?
Yeah. Continuing on for control activities, you want to make sure that control activities have been selected and developed. And if you have a significant number of data points to report on, a tiered prioritization approach may be appropriate. With control activities, you'll also want to perform a readiness assessment as recommended by the COSO publication. A readiness assessment essentially takes a look at your current control environment versus what the control environment should be, and allows you to identify gaps sooner rather than later so that you can remediate them. For information and communication, you want to use relevant information sources and create a traceable audit trail. That audit trail should incorporate review and approval process so that information is meaningful and represents the organization's actual underlying activities. And finally, rounding things out, we have monitoring activities. Monitoring activities is where you evaluate and communicate deficiencies. A meaningful monitoring system can lead to strategic reassessment and an organizational reflection on its commitment to sustainability reporting. Next slide.
Okay, great. Thanks, Rachel. And so, we mentioned earlier about discussing control activities that's applicable to sustainability information, and that an organization may have a significant number of data points reported, but that it also may be preferable to consider conducting a risk assessment as suggested in the COSO report. And so you're aware of your current state and gaps to be able to address for internal control and governance implementation. So thought we share our approach at a high level on efforts to conduct an audit readiness to evaluate a client's company's processes and possible controls and identify the gaps. So you can see here these multiple layers or steps in terms of first having to understand the process scope and having to determine the scope for review, as well as evaluating the boundary and the materiality for the organization. Then having to assess and evaluate, having to conduct walkthroughs and process map and confirm processes and procedures, and evaluate for controls. And then having to shift over, once we have an understanding of the current state, having to be able to help process and control design, having to define and document process controls and the gaps associated with it. And so in this stage, this includes having to consider, be able to help guide clients on process and control design to remediate those gaps. And then the last part here in terms of design effectiveness, this is just to mention in that, when a client implements the controls, we can return to be able to conduct the testing to be able to confirm the effectiveness of the controls designed. And so this is an area that we help assess and navigate clients through the approach described here. And we'll share some examples at a high level just for illustration purposes only, so that you can be able to gain a little bit more examples and understanding.
Thanks,
all right,
Janis.
Rachel?
So when you're evaluating gaps pertaining to ESG reporting, what should you consider to appropriately assess reliance of the metrics prioritized for in-scope review? It's at the entity level and the transactional level that you'll want to take a look. At the entity level, it's all about evaluating organizational governance processes and controls, particularly board governance and management's role to establish internal oversight. At the transaction level, you want to evaluate processes and control activities around ESG metrics. In other words, how the quantitative information was pulled together and calculated and reported upon. Next slide. This brings us to polling question number 4. How would you answer this question for your company's current state? A, we have entity level controls in place around ESG data. B, we have transactional controls in place around ESG data. B, we have both entity level and transactional level controls in place around ESG data. Or D, we have neither entity level nor transactional level controls in place around ESG data.
So we'll give everybody a little bit of time to answer that polling question.
Okay, the results are in. It looks like the number one response is we have neither entity level nor transactional level controls in place around data, ESG data, followed by we have entity level controls in place around ESG data. Okay, this is good to know when we're getting into now next describing entity level and transactional level controls around that data. So let's start by talking first about board governance at the entity level. Board governance is about guiding ESG direction, and there are certain attributes you need to examine when evaluating board governance. Let's take a look at those attributes. The first one is board expertise. You need to ask whether your board has ESG expertise. Does it have it through training or addition of new board members? Next is board oversight responsibility for ESG. Who's going to have responsibility for reporting for ESG? Will it be the full board, an existing committee, or a new ESG committee will be created? Next, you want to look at board charters and reporting cadence. Any board charter that has been impacted by ESG needs to be updated for the responsibilities. And the frequency of board updates on ESG needs to be defined. Next board governance attribute is maturity. And that is, the board needs to understand the company's ESG maturity level and what is the effort needed to get to the desired maturity level. And then finally, the last attribute of board governance to consider is enterprise risk management strategy. The board needs to incorporate ESG risks into risk management and strategy discussions. Management governance is more about establishing internal oversight. Governance at the management level tends to be more tactile and ranges from responsibility to consideration of internal controls over ESG data. Let's take a look at the attributes of management governance that should be considered. The first one is responsibility. Who is going to have responsibility for ESG data? And who's going to have authority over it? What are the resources going to be allocated to it? What about reporting line? Is it going to be a cross-functional team or just a team of 1 or 2 people that are responsible for it? Next is the cadence reporting to the CEO and the C-suite executives. The cadence of reporting on ESG needs to be defined, and whatever is appropriate, whether it be monthly or every 2 months or quarterly, whatever is appropriate for the organization, that needs to be determined. Next, managing governance aspect to consider is adoption of an ESG framework, such as what Janis had mentioned earlier, the global reporting initiatives, or the Sustainability Accounting Standards Board. Both of them are frameworks that can be adopted by the company. Also, you want to consider the existence of materiality assessments. The importance of the materiality assessment is it allows you to identify the most important metrics the company should be reporting on. There's only so much limited time and resources available, and those need to go to the most important metrics. Another governance aspect at the management level is creation of ESG policies and procedures. And not only creation of those policies and procedures, but communication to impacted individuals. And then finally, you want to consider internal controls over ESG data, all the way from collection to reporting and putting those into practice.
Great, thanks, Rachel. I'm just going to mention this because we are coming close to time with under 5 minutes left. So just wanted to quickly highlight, these are just 2 examples that we wanted to share, Western Union and Williams-Sonoma International. But the slides will be available to you after the webinar. Just wanted to at least illustrate in terms of from a board governance as well as management governance perspective. And we just want to be able to make time to talk through the last 2 control slides as well. Okay, so just quickly highlighting in terms of illustrating a little bit more, now we want to just be able to share some illustrations of control activities at the transaction level and focusing on the reporting of the carbon emissions for an office-based organization. And the organization may have an inventory management plan that documents the organization's methodology and the approach to capture their greenhouse gas emissions. And there may be an internal process for the organization to essentially complete their high quality inventory, and possibly additional policies and procedures at divisional or business unit and regional level. Now, Rachel?
Yeah, given what Janis has just mentioned, two potential controls you could have in place would be one over the inventory management plan and one over the division policies. For example, you could have the inventory management plan is updated annually by the process owner team so that the INP has the most current information. And the real control is the process owner reviews and updates the updates made to the INP and electronically approves the INP annually. And then as far as around division policies, we could say division policies for collection and measurement of greenhouse gas emissions are updated annually by Division A's process owner teams. And again, the real control here is the policy owner reviews the updates made to the policy and electronically improves Division A's policy annually.
Great, and then continuing on to the prior example, now if we focus on closer to the emission metrics associated with purchased energy used for the facilities or buildings, here are a few other examples that can be from a review perspective that Rachel will share just at a high level.
Sure, we could have a control around electricity consumption calculation and one around the emission factors utilized for the calculation. For the electricity consumption calculation, you could say is reviewed by the process owner, and then you can go through the review procedures, and then the real control is the review is evidenced by the process owner's sign-off and notes on the calculation detail. And then for the emission factors utilized for the calculation, you could say they're reviewed by the process owner and go through the review procedures, and then wrap up the control with the review is evidenced by the process owner's sign-off and notes on the summary detail report. Janis?
Great. Well, thank you, Rachel, for sharing that. And I know we're coming up in time, but I hope you find at least the updates and the high-level illustrative examples helpful and informative today. I want to just be able to share some resources with you. Again, the slides will be available to you after the webinar, probably about a week after. And then the other thing was that I wanted to be able to present and bring the information together, wanted to show from a two reporting workstream perspective that we discussed earlier, expanding on sharing the services that we currently offer here at RGP, and it's illustrated here to be able to address the organizational needs around ESG reporting. So you can see the three work streams that we have from SEC readiness, ESG metrics audit readiness, and sustainability program assessment perspective, and other elements that's listed here if you have any questions. And then also, as you're planning to embark on the transformation necessary in order to establish your ESG program structure reporting efforts, you may want to also consider incorporating key elements that help you attribute to the success of projects and your transformation journey. So these are additional services offered at RGP to help organizations drive project success. And with that, we are out of time for this presentation, but if you submitted questions, we will get back to you. I want to thank you for attending this session today, and this concludes our webinar presentation. Thank you, Rachel, for co-presenting with me today.
Thank you.